everyone. My name is Omega. No, there is no Alpha, and that is my real name. I'm the content manager at SME South Africa, and welcome to the SME Podcast. I'm here with an icon, a legend, and what I call a mezzanine debt finance guru, Mokgome Mogoba. How are you, Mokgome?
No, I'm good. I'm very good, thank you.
Do you agree that you are a mezzanine debt finance guru?
You are very kind. You are way too kind.
Yeah. I mean, after all those years
Thank
of
you.
experience, then I don't think there's any other title that fits you.
Thank you.
So to start it off, can you please just tell us about yourself, your background, your journey, and where you are now?
Okay. No, thank you very much. Yeah, so I trained as a chartered accountant, so I did a BCom accounting and honors in accounting, BCom accounting and finance at University of Natal, Durban, Howard College. So this was before the merger with, Durban Westville to create UKZN. So I was there from 1998 to 2002. And then towards the end of 2002, I then joined Standard Bank. I joined Standard Bank's top program, so training outside of public practice, to serve my articles to qualify as a chartered accountant. So those were the early years when, because before then, if you wanted to become a CA, you would have to do your articles with an auditing firm, either PwC or KPMG, Deloitte, or Ernst & Young. And then around 2000, then that's when, SAICA, the accounting professional body, decided that, corporates and banks can also then offer articles, so that if you are not inclined towards auditing, and you're more inclined towards, I guess, commerce or corporate, then you can do your articles there, for a period of 3 years. So I guess when I was at varsity, I was, to become a chartered accountant, you have 4 majors. So your majors are accounting, auditing, tax, and finance. So you normally find out during your studying which of the 4 subjects you tend to enjoy. They call them the big 4. So in as much as I was good at all of them, but I think my favorites were always finance and tax, which is why as soon as I could move into banking, finance, then I decided to do that. So hence I decided to serve my articles with Standard Bank. So for a period of 3 years, I rotated through, various divisions within the bank, retail banking, corporate and investment banking, group finance, group tax, and so on and so forth. And so 2005, I then joined, after I finished my articles and I passed my board exams, I then joined Standard Bank's private equity team. It was a very senior team, a team that had senior deal makers in the team. And and I learned a lot. And early 2006, so my fellow colleague who was senior in the Standard Bank private equity team, then approached me and said, he wanted to set up Standard Bank's mezzanine debt team. So mezzanine debt was still a very new asset class, in the market, in South Africa and internationally. And he had managed to obtain approvals within the bank to set up Standard Bank's mezzanine debt team. So myself, his name is Luke Albinski. So myself and Luke, we were then the founding members of the Standard Bank mezzanine debt team. We did a few transactions. I think our first transaction was providing funding for the leverage buyout of Weco. Weco, a scaffolding and building materials business, by JP Morgan, which was an international private equity firm. So that investment amount, I think, was around 900 million. And then the second transaction was we structured the DBS Bonahalo B transaction, which was one of the largest deals at the time, 6.9 billion rands of funding that Standard Bank provided into that B transaction. And then 2006, Luke then decided to leave Standard Bank. He joined Vantage Capital. to set up what was one of the first mezzanine debt funds in South Africa. He tried to get me to leave Standard Bank with him at that time. In fact, I remember there was a time when I'd actually resigned from Standard Bank, and an announcement went out that I had left. And then the powers that be at Standard Bank, I guess they fought very hard to keep me. And then I ended up not leaving. And Shemluk was very understanding. So then I was then joined in the Standard Bank mezzanine debt team by a gentleman called Alex Otto. And then we also joined by Andrew Kotejo. And then between 2006 and 2008, we executed a lot of mezzanine debt transactions.
Okay.
So Standard Bank also had a leverage finance team. So leverage finance was more senior debt, lower risk deals. So their senior debt deals went to credit committee. Mezzanine debt, because was considered to be a little bit higher risk, we actually took our deals to a different committee, to an equity risk committee. So at the time, the leverage finance team would focus on senior debt deals, and the mezzanine debt team will focus on the mezz aspects of all the transactions. But 2008, a decision was then taken to merge the two teams, so that as a deal maker within leverage finance, you can structure both senior debt, bank debt, and mezzanine debt on your own transactions.
While you're on that, I wanted to ask, what is the difference between senior debt and mezzanine debt? Because they sound quite intertwined, but I'm like trying to understand, what is the difference between the two?
Okay. So senior debt... senior debt, is the most common type of bank funding. So when you look at the capital structure of a business, so you have senior debt, which is low risk funding. So banks tend to be very conservative. So they will provide a loan instrument, typically 5 years, and then that loan instrument will amortize over the 5 years. So the bank wants the capital to be repaid over that 5-year tenure. They want to see that exposure reducing over that 5-year tenure. And the bank also likes to see assets that they can take as security, as collateral.
Yes.
Okay. So based on that, the bank will then decide what their appetite is. Okay. In terms of, the amount of funding or the maximum amount of funding that they can provide. So that's senior debt. And then you also have equity. So most people understand equity. So equity is permanent capital, it's long-term capital. If an equity provider provides you with capital, then they want to take ownership in your business, also have a shareholding in your business. And when you give away that equity, or when you sell that equity to an equity provider, that shareholding is gone forever. It's theirs, right? And then they can decide the day they want to exit, they can decide who they want to sell that equity to. So it's gone forever. So mezzanine debt sits in the middle. So as mezzanine debt, we rank behind senior debt from a security perspective, in terms of security, and also from a cash flow perspective. So meaning that when the business generates cash flows, they repay they pay the capital and the interest on the senior debt first. And then if there's any cash flows remaining, they will then service the interest on the mezzanine debt. And then if there's anything remaining after that, then whatever is remaining can then be distributed as dividends to shareholders. So the priority of the ranking is senior debt, mezzanine debt, and equity, from a cash flow perspective.
Hence it sits in the middle.
In the middle. And then similarly, from a security perspective, the bank will register first ranking rights to security, And then as mezzanine debt, we always then register second ranking rights to security. And equity providers, they take the most risk. So they're generally not secured by anything, because they're equity. And what does that mean? That means that if the business was to go down, if the business was to be liquidated, right? And the assets of the business then needs to be sold, to to try and recover proceeds, right? So what that means is when those assets or when that security is sold, whatever the proceeds are, those proceeds will get used to settle senior debt lenders first. If there's anything remaining, then mezzanine debt lenders will get settled second.
Okay.
And then the last people in the queue will then be your shareholders or your equity providers. Then they will recoup last their investment.
That's very interesting. I'm sorry I took you off track
Okay.
in your journey.
Yes.
You were still explaining the point where the senior debt team and mezzanine team joined. So you can continue from there.
Okay, lovely stuff. Yeah. Yes. So 2008, the two teams merged so that now as a transactor or a deal maker, you can structure both senior debt and mezzanine debt on your own deals. So I was part of that team until 2011. So meaning I spent 9 years at Standard Bank, 2002 to 2011. So at the time when I left Standard Bank, so I headed up, a few sectors, within leverage finance. So I headed up financial institutions, funding to financial institutions. I headed up BE financing, financing to black investment holding companies. I also headed up, for example, public sector, funding to state-owned enterprises and then funding to the government as well, and a few other sectors. I mean, to give you an example, my team during that 3 years, for example, we provided a 1 billion growth facility to Old Mutual Finance. Okay. So Old Mutual at the time, they just opened up like a micro lending business, to try to take on the likes of African Bank and them. So then we put together a 1 billion rand funding line for them. And then to give you another example, we provided 2 billion of funding, to Shanduka Group. Shanduka was actually Cyril Ramaphosa's B company, at the time. So the business was doing well, looking for growth funding. So Standard Bank, we then provided a 2 billion rand, growth facility to the group at the time. So then 2011, Luke approached me again, Vantage.
He was waiting.
Yeah, he was waiting. At the time, Vantage, had managed to raise Fund 1, which was 1 billion. That fund was fully deployed. They were now starting to raise Fund 2. Okay. And they needed a bigger team. So Luke approached me, and funny enough, he approached my colleague as well, Zahir Kasim. We were actually in the same team. Zahir was 8 years at Standard Bank. Okay. And we worked together. So myself and Zahir, we joined Vantage basically same time in 2011. So spent 9 years at Vantage Capital. So during that time, we raised 2 mezzanine debt funds. Vantage Mezz 2, which was 1.9 billion, and Vantage Mezz 3, which was 4 billion. We also raised 2 renewable energy senior debt funds. So GreenX 1, which was 2.2 billion, and GreenX 2, which was 3 billion. So the Vantage, mezzanine debt funds are pan-African funds, meaning that Vantage covers the whole continent. And the way we structured the team was that the whole team covered South Africa. And then we divided up the rest of the continent. So on top of my South African responsibilities, I also headed up East Africa for Vantage. So I headed up our investment efforts in markets such as Kenya, Ethiopia, Rwanda, and Uganda. And then my fellow partner in Kolo Capital, Zahir Kasim, whom I had already mentioned. So he headed up Tanzania, Zambia, Botswana, and Mauritius, for Vantage Capital. So for that 9 years, I covered East Africa as well. We made a few investments in East Africa. I used to spend on average 2 weeks, every 2 months in East Africa, So I know East Africa very well. So East Africa became my home, my second home. So then 2019, myself and Zahir, we decided to leave Vantage Capital. We always had this idea to set up our own mezzanine fund, but the plan was not to set up the business immediately.
Okay.
Because having worked nonstop for
18 years
plus. 18 years at the time, we felt like we needed a break.
Yeah.
I needed a sabbatical, like a proper sabbatical, so this was towards the end of 2019. So my plan was to travel until I got tired of traveling.
I'm assuming you would have traveled for 9 years because it seems like 9 is the lucky number.
There we go. Yeah, the intention was to travel maybe for 18 months to 2 years.
Yeah.
Because I remember I left Vantage, then I spent a month in Mozambique because it was in our summer, right? Southern Hemisphere summer. I spent a month in Mozambique. I spent a month in Botswana. And when COVID hit, I just come back from Namibia. I spent a month in Namibia. So the whole of Feb 2020, I was in Namibia. So I was still planning on doing Europe in their summer, Latin America, Southeast Asia. So then COVID hit, March 2020. And then 2 months sitting at home doing nothing, level 5, lockdown. Then we're like, Flip, we're sitting at home doing nothing. We're not traveling.
Yes.
Flip, what? We might as well just set up the business because now we're not getting that sabbatical or enjoying that sabbatical that we needed. So May 2020, that's when we started, laying the foundations for the business.
Wow.
So coming up with the name, coming up with the logo, designing a website.
Okay. I just want to pause.
Yes.
Let's hold it there for a bit. Because we were meant to play an icebreaker, but then we just dive into this conversation. Wow, your journey is really, really interesting. And just the experience in the room is so inspiring. But I just want us to do something lighthearted just a bit, then we'll go back into the serious conversation.
Okay.
I wanted us to play an icebreaker called Fund or Pass. Okay. So basically, I'm going to highlight just a few business scenarios for Mokgome, and then he'd tell us whether he would fund the business, whether he'd pass on funding it, or whether he would potentially structure it to be ready for funding. Okay, so it's a one-liner, right?
A one-liner, okay.
Yes. So a founder walks in and said, "The bank said no, but hear me out." Fund or pass?
Not enough information to make a decision.
Right?
Yeah.
So what information would you possibly need?
The first obvious one is why did the bank decline? The funding opportunity, and then we can take it from there.
Okay.
Yeah.
The second one, a company has one big client that brings in most of the revenue. Fund or pass?
Pass.
Why?
Yeah, because, customer concentration risk is very risky. So if you are a business that only has one customer, then when you lose that one client, that one big client, then it means you don't have a business anymore. So that introduces a lot of risk and credit risk, in the business.
Okay.
Yeah.
This is the last one. A founder has big projections, a good concept, but no evidence that customers will actually buy or any market traction. Fund or pass?
Pass.
Yeah, that was an obvious one.
Yeah.
But I just had to ask for our audience out there. Okay, so now we get into understanding Kholo Capital, right? Starting with the name and what this business intends to do. What kind of businesses are you guys looking for?
Okay.
Yeah.
Okay. Yeah. So maybe starting with the name. So Kolo or Kholo, so the reason why we liked the name and actually decided to go with the name is because the name has different meanings in different languages and different cultures. So myself being Sotho, so in Tswana it's actually Kolo. Kolo means growth in Tswana. So you pronounce it Kolo. Kolo means growth in Tswana. And then in Sotho, when you say Ekolo, Kholo. Kholo means big or massive.
So it's Kholo, not Kholo. Or does it depend on?
Yeah, no. It's Kholo or Kholo.
Oh,
It's
okay.
KH. It's not
Okay.
KG.
Oh, okay.
So it's KHOLO.
Kholo.
Yeah. So in Sotho, when you say Kholo, that means big or
Big
massive.
or massive, yeah.
Right. And then in your Nguni languages, so Zulu, Xhosa, Swati, Ndebele, Ukholo means faith or belief.
Wow.
Right? And then in Indian languages, in Hindi and Bengali, Kholo means to open. So I think we found a lot of resonance with the name, and also all the positive meanings, attributable to the name. The meaning that speaks most to our business is actually the Tswana meaning, Kholo, growth. Hence our tagline is Masters in Growth, because we like to see growth and we like to fund growth.
That's beautiful.
Yes.
Yeah. Okay, so what do you guys do? And who are you looking for? Who is your target?
Yeah. Okay. So Kolo Capital, first and foremost, is a fund manager, right? So maybe just to explain the industry structure a little bit.
Yes.
So we are a fund manager, and we are a fund manager that invests in private companies. So that is different to asset managers. So asset managers tend to invest or buy shares in listed businesses. So a company like Stanlib or 91, or Old Mutual Asset Management, Coronation, Allan Gray, they would typically invest in listed instruments.
Okay.
So they would invest in listed shares, buy listed shares in listed companies. They would buy listed bonds. They are fixed income teams. So they'll have like an equities team that invests in listed shares. They'll have a fixed income team that invests in listed debt. So bonds are actually listed debt. Whereas fund management is more private markets. So we look at your smaller businesses, not your big listed entities.
Yeah.
So we're looking at your medium-sized private companies, your small to medium, and sometimes even your sizable private companies.
Okay.
But these are companies that are privately owned, privately run. And these are businesses that need growth capital. They need CapEx, they need working capital, and they have many other needs, right? So I just thought I'd start there. So we are a fund manager operating in private markets, meaning that we provide funding to private companies. Now, what type of funding do we provide? So fund management, the most common fund managers are actually private equity funds. South Africa, the South African private equity industry is very developed. I think if you look at the Private Equity Association in South Africa, SAFCA, the number of members they have, I think we probably have more than 200 private equity funds in South Africa. So private equity and equity, fairly well understood concepts. So we are a little bit different. So we are not a private equity fund. We are a mezzanine debt fund. And the question is, what is mezzanine debt? And I think the best way to explain mezzanine debt is by explaining our value proposition.
Okay.
So what we say is, if there's an equity funding gap, if the business needs to raise equity for whatever reason, whether to fund growth, to fund an acquisition, to fund a management buyout, to fund a private equity buyout, to exit shareholders. So if a business needs to raise equity for any reason, what we say is, instead of raising equity and giving away shareholding in your business and giving up control of your business, then consider raising that equity funding amount as a loan instrument. So you come to us, we will provide that funding as a mezzanine loan instrument, typically a 6-year loan, interest only.
Okay.
So meaning the business only has to service interest on the loan. Sometimes we're even willing to roll up interest, to accommodate growth, especially in the first few years of the business or of the funding. And after 6 years, the business can either repay the loan or refinance the loan using cheaper bank debt, but then you still own 100% of your business. So maybe an anecdote would be to say, when you bring in a private equity investor, so private equity is a marriage. When you bring in an equity investor, you're actually entering into a partnership similar to a marriage.
Yeah.
And that equity investor is in your business basically forever. It's permanent capital, right? Yeah. Whereas I would say mezzanine debt is more like dating. So you date us for 6 years.
Yeah.
Yeah, then after 6 years, you can go back to being single again.
I like that analogy.
Yeah.
Okay, I was wondering while I was reading about your business and like the target audience, do you find that you guys are successful in attracting the right business? Or do you often have to turn people away to say, Ish, you're kind of too small or not really fitting in the type of business that we're going for?
No, listen, it's a bit of both. It's a bit of both, because, and which is also a nice problem to have.
Yeah.
It's a nice problem to have, because I think the business having been around for 5 years, but then also, the team having a lot of experience and a long track record within the industry and a lot of networks, and contacts, we get fairly busy. We get fairly busy, because we have a lot of businesses, entrepreneurs approaching us for funding. I would say to you it's 50-50.
Okay.
And we appreciate everyone that approaches us for funding. Because, for example, I think we've managed also to develop a good ecosystem with other lenders. For example, we have nice partnerships with lenders that, for example, focus on much smaller businesses. They would provide, say, funding from $500,000 to 10 million. Then we have other lenders that provide, let's say, 2 million to 20 million. And then the other funders that provide 20 million to 50 million.
Yeah.
So for example, now if a deal doesn't fit a mandate, or is too small or whatever reason, then we're able to then put that business with the right funder.
I love that.
And vice versa. When those funders get opportunities that are, for example, maybe too big for them, then they refer them to us. So we actually have a good network of funders and lenders, that provide funding to much smaller businesses. And then, for example, we also have a good network of venture capital firms as well. Funders that provide startup capital. Okay. So for example, if we're being approached by a business and we feel like the business is too early stage for us in terms of our type of funding, we have a nice panel of venture capital funds that we then refer those deals to, and then also vice versa. So I think it's a good thing, and it's a very nice thing that we've managed to build this ecosystem, because it means every opportunity that gets introduced to us, we manage to find a home for.
Yeah.
So we managed to solve that problem and put the business with the right type of capital.
Okay.
Yeah.
I saw a CityWire article with the headline, Kolo Capital's Mokgome Mogoba says the real gap in SA's missing middle is not capital, but alignment between funding structures, cash flow realities, and investor expectations. Can you unpack what you meant by, like, what missing middle looks like for you, and what you meant by alignment between funding structures, cash flow realities, and investor expectations?
Okay. Yeah, so the best way to put it is maybe starting with a startup, right? So let's say you're setting out a new business. You're just starting out. The business is still trying to acquire customers, still trying to generate revenue. That type of business would not be able to raise bank debt, right? Because banks, being as conservative as they are, and banks, the type of funding they provide, because a bank will want to provide a loan. That loan interest will need to be paid monthly. Capital will need to be repaid monthly. Now, if your business is not cash flow positive yet, then it would not be able, even if the bank gave you a loan or anyone else gave you a loan for that matter, you wouldn't be able to service that loan.
Repay, yeah.
Yeah, you wouldn't be able to service or repay that loan. So a business like that, the suitable type of funding for that type of business is actually equity, right? It's actually someone that will give you money and say, listen, I'm investing this amount, and for this amount, I want this percentage shareholding in your business. And I'm going to be very patient. I'm a very patient investor. I'm providing you with permanent capital. I'm willing to wait 7 to 10 years to start seeing dividends, or to start seeing a return on my investment. And that is what equity is. Equity is patient, very, very patient capital, and it doesn't need to be serviced, So you don't need to pay anything, It's only maybe after 6, 7 years when the business is profitable that it can start distributing dividends. But there's no obligation to pay a dividend. Yeah. You know what I mean? So so that type of business would clearly need equity funding. Then let's go to the opposite extreme. So let's say you have a big business, lots of customers, long track record, lots of assets, right? Cash flow generative. Now, if that business needs to raise funding, all the banks are beating themselves lining up to give that business funding. Yeah. For example, when Vodacom raises funding, Standard Bank and RMB are willing to kill, to provide funding to like a Vodacom. So a business like that can raise bank funding, which is the cheapest form of funding. And the banks, because they're competing to get that funding, then they reduce their pricing drastically, to win that funding. So now that is the opposite extreme. So you have equity, which is actually the most expensive form of funding, suitable for early stage type businesses. And then you have bank debt, which is the cheapest form of funding. And the guys that get that funding are your big established businesses, right? And then there's everyone else in between, right? There's everyone else in between. So this is where we come in. So now you have businesses that are not early stage, but also they are not too large. Because also the funding gap is also created by the fact that, the banks, being as conservative as they are, and as risk averse as they are, they give a lot of attention to big corporates, big clients. When a Vodacom comes, they're willing to drop everything.
That's true.
But when a smaller, medium-sized business comes, they don't get as much attention, right?
Yeah.
Or they don't raise the full amount of funding that they need to raise. So that then becomes the missing middle, right? That then becomes the missing middle because you have businesses that are small or medium-sized, they're cash flow positive, they have good management teams, they are well-run, they want to grow, they want to grow into new products, they want to grow into new markets, they want to buy equipment, they want to build a factory, they want to build a warehouse, they want to buy stock, and they need funding. And they need funding, but they're not getting the required amount of attention from the big banks, because the big banks are focused on the big clients. Now, and that is generally where we come in, Because also, I mean, the big banks, I mean, banks, the way they're structured also, it's a little bit of like a funnel in the sense that, you find young people joining a bank, then they move up. But because it's a funnel, because there's few positions at the top, then your more experienced deal makers end up having to leave.
Sure.
And find other, greener pastures. But generally, the most natural progression for a banker would then either to move into corporate or to move into private equity or, set up your own fund. So now what does that say? That says that a lot of your private equity fund managers are actually experienced deal makers and experienced bankers. Whereas a lot of people that are in banking, they're still junior. And sometimes it takes an experienced deal maker, to be able to understand the business properly and unpack a business properly to be able to structure a deal and provide the right type of funding. You see, so the point that I'm trying to make is, so banks generally have junior bankers, and junior bankers are not very good at understanding complexity or understanding entrepreneurs and being able to provide the right funding. They're good with vanilla type funding. If you're providing a vanilla loan to a big corporate, low risk, that's fine. If you're providing an overdraft facility, that's fine. Low risk, low return.
Yeah.
Banks are happy with it. Your senior bankers, generally, they've left banking. And where do they sit? They sit in fund management.
Wow.
You
That's
see?
beautiful. I think
Yes.
unfortunately, time is a thief.
Yeah.
I wish we had more time, but I
Yes.
think you've closed it off beautifully by addressing exactly who the missing middle is and why they'd benefit from coming to funders like you.
Yes.
But I know that we're still going to get to hear more from you on the 18th of June at the
Definitely.
SME Funding Summit at Focus Rooms in Sandton. 18 June, guys. You're going to see Mokgome there if you want to hear more. Thank you so much.
Thank you. Thank
for
you
all your
very much.
knowledge and experience. Like, wow, I'm actually so inspired.
No, thank you very
Thank
much.
you.